Hey everybody, this is home loan expert Dan, and today I'm going to be talking about a very important topic, and that is an amortization calculator. I think anybody that's taking out a loan, especially a mortgage, should have an understanding of how amortization works, which is basically based on, your loan amount, your term. In this case, we're going to be using an example of a 30-year mortgage, which is the most common, and how your interest has an impact on what you pay over the life of that loan. Okay, I'm going to show you this example. I think it's great for presentations. There's also plenty of sites that you can go to get access to an amortization calculator here. If you just type in amortization calculator Excel, you can pull up this one here right through Microsoft Excel and you can play around with these numbers yourself. But I'm going to show you how this works. So I'm going to start off by just assuming that somebody is taking out a loan of $300,000. We're going to use a 30-year mortgage. You don't have to, typically you can go under a 30-year mortgage like a 20 or 15 year. In that case, you would just plug in 20 or 15 years for the term. And I'm not advertising any rates. I'm just using this as an example for today of 6.75%. Uh, Rates can vary just based on the market, loan program, credit scores, lots of different things. So I'm going to make a separate video on that. I'm just using this as an example, okay? So before I play around with anything else on the bottom, I just want to run this through as is. So this is assuming that somebody's taking out this loan, they're making the minimum payments, they're keeping this loan for a full 30 years and not paying anything extra. So that's the first example that we're going to run today. So let me just hit calculate on that. So the first thing we can see here is the principal and interest payment, $1,946. Keep in mind, this is just based on principal and interest. It is not including any property taxes or homeowners insurance, which are a lot of times part of your total mortgage payment. So we're just looking at the impact of the loan based on the term and the rates, okay? So this is the amount that would be fixed as long as you have this mortgage. Now, over the full 30 years, again, if you make the minimum payment, you never refinance, you never pay anything extra, you are going to end up paying $400,000 in interest. Okay, it's a big number. Chances are anybody taking a loan out right now, just based on where the market is and everything like that, there's a great chance you're not going to have this loan for 30 years. You might sell the house, you might refinance, you might pay off the loan early by your own means. But this is kind of, worst case scenario based on, again, where the market is right now and what the interest rates are. Okay. So just quickly, so we can understand this together, this shows how much you're paying in interest and principal as you go through the year. So in year one, your loan balance is the highest. So you're paying the most in interest in the beginning years when your loan balance is the highest. As you're making your mortgage payments, that's recalculating how much of your payment each month is going towards principal and interest. So as you go through the years, you can see you're going to start paying more in principal than interest. It's going to take a while to get there, but let's just start off on the top here, right? So we see on that first payment, 1688 is going towards interest and 258 is going towards principal. And as you make the payments, again, your total payment amount stays the same because it's always that same amount, the 1,946. And then as you pay that mortgage balance down, it starts to get a little bit more towards paying the principal. Now, the point where it flips, again, is later on in the process. So once we get down to about the 20-year mark, right? That's when your payments start to go more towards principal than interest. Okay, so if you have an amortization calculator, you can take a look at this and you'll see exactly how much is going towards principal and interest based on, what month of your payments that you're in. But now let's do this. This is a very powerful thing. I want to show you if you're able to pay an extra $100 per month on top of your minimum monthly payment, what impact does that have on your mortgage? Okay, so we run the numbers again, paying an extra $100 every month. The main things we see, it takes it from 360 months, a full 30 years, to 311 months. So if you make that extra $100 payment per month, you're going to save just over 4 years off your loan. You're going to turn that 30-year loan into just under a 26-year loan. And remember, we were just seeing that you paid over 400,000 in interest without making any additional payments. Now, with paying the extra 100 per month, you're saving just over 65,000 over the life of your loan in interest. So it is very powerful to prepay. And again, there's no prepayment penalty on most loans that we do have, including conventional loans, FHA, VA, USDA, pretty much no loans that are going to be conventional 30-year are going to have any types of prepayment penalties. Okay, there's some non-QM loans. It would be heavily disclosed if any mortgage has a prepayment penalty. You always want to double check that, but this is assuming a 30-year fixed rate. So let's even just take it one more step further and say if you put an extra $200 per month towards that payment each month, well, then it takes your 30-year mortgage down to about a 22-year mortgage. And instead of paying over 400,000 in interest, you are now paying 290,000. So it's a savings of $110,000 in interest over the life of the loan by paying an extra $200 per month towards that payment in this situation. So again, this is very powerful stuff. But the main thing to know with an amortization calculator and with mortgages is every time you make a payment, your next payment is always based off your remaining balance as far as what's going towards principal and interest. So you don't have to just do this monthly. You could also have a lump sum of money that you get at some point. You sell your boat or something, whatever it is that you have some money that you'd like to put towards your mortgage, right? So let's say after 2 years, so on payment number 24, you have $10,000 that you received, and you'd like to put that towards your mortgage to reduce your mortgage balance. Okay, so that also calculates and causes the remaining interest you're paying to go down as well, because every payment after that is based on a much lower balance than would have been if you did not put that extra money towards your loan. So again, you can play around with this. A lot of computers have their own amortization calculator installed on them. You can grab the one from Excel or just search one up there too. I'm happy to put proposals together and specific examples for you as well and answer any questions that you might have about amortization. This is really powerful. I appreciate you guys for stopping by and paying attention to this too. If you have any questions on this, please do let me know. If you have any other video ideas you'd like me to cover, also let me know. But thanks again so much for stopping by, and I hope you all have a great day.